Hello and welcome to the Self-Storage Report. I am one half of your dynamic duo, Thaddeus Campbell, Director of Business Development and Strategic Branding for S3 Partners, host of the Stories Behind the Door podcast. He is my better half, Chris Berg, host of the
known as Batman, right? The dynamic duo. I'll be Batman.
You're Batman, I'm Robin. He's Chris Berg, host of the CRE Report and the acquisitions lead for Abernathy Holdings, developing self-storage throughout California. Listen, we're having a blast with this, and we've been really excited to see the response. So first of all, thanks to all of you guys who have reached out and commented and give us some feedback. Got to say, Chris, was a moment of joy. We had mentioned Philip Anderson on our podcast with the Secret Life of Real Estate and Banking. He actually liked one of our LinkedIn posts, which is kind of a fanboy moment for me. I was pretty excited. Listen, getting to the deep point of it, we think there's a need here. We think that it's really important, especially now at what we feel, you and I think we're very agreed on this, is a critical juncture in the real estate cycle. And so we're excited today to come on and join you guys and share some concrete information. I know you've been communicating me with all week since we were on last Thursday, because there's been a lot going on and a lot of things that you've been seeing that are sort of helping you to solidify your take on what's going on in the market right now.
Yeah, so I think the headline is we're going to talk about, hey, is the market starting to soften, right? The GDP numbers came out this morning. They're softer than anticipated or revised down. But KB Homes and R both saying, hey, the market's softening. So we're going to play some clips from that. Some very interesting news about their land acquisition strategy, or maybe how that is dramatically changing. But also I want to share with people, hey, here are some signals you want to be looking for over the next 13 to 24 months to help you prepare.
I think that, to your point, that it's mind-blowing to me, and I'm excited to see you get to this data, because it has the ability to really kind of, create what it is we talked about last week, right? You and I believe in this 18.6-year real estate cycle, and there's some significant markers, and I know you're going to bring up some stuff. Before we transition into that, I want to
just interrupt, because
yeah, of course.
What I want to talk about this cycle, because a lot of people are like, man, what are you talking about? Like, I think what I would encourage people to do, and I said this to you the first time, I said, look, I don't know if this cycle is true. All I know is I'm trying to poke holes in the thesis, and I haven't been able to do that yet. So for people out there, I'm going to share with you the best, and also Thad, the best of our ability, the information that we're seeing. If you can poke holes in the cycle, please do, because so far it's been a really strong thesis, but always open to saying, hey, you know what, this isn't working, that's not working, and having that conversation.
Yeah, I mean, listen, I'll give a brief summary of the book. And, and Philip J. Anderson, it's a phenomenal 500 plus pages, just backed with data over and over again. And to your point, it's happened over a dozen times since the inception of central banking in the United States, right? Obviously, now we have the Fed. At the beginning, we had a central bank. This cycle has repeated itself on a very, very clear timeline repeatedly. We alluded to last week, the exception being World War II, and the Depression before is the only time that it kind of threw off the timeline of how this real estate cycle happened. More importantly, what were the indicators of the cycle coming to its end? And I think that's why I'm excited to see what you're going to bring to us as we go through the show, because there's some very clear reasons to think that we could be coming up to what you said last week, middle to end of 2026, where we might want to be prepared for something. I'm also intrigued, we've talked about this offline, about your thoughts about where we're going to see it, right? 2 cycles ago, the late 80s, early 90s, really doomed George Bush's second term as a president. He was not able to win re-election because of the savings and loan crisis. That's how that one played out. We saw in 2008, it was residential homes that really created it. I'm interested to pick your brain about how you think we might see the 2026, if we do see it, where it might play out. Before we get to that, go ahead.
To sum that up, and what I want to do then with all this information is that you and I can then help translate that into, so what does that mean for self-storage? This is the storage report. So I think, again, homes can be a leading indicator. We all know that, people moving is a big, big driver for the storage business. So as we look at maybe what KB said in the earnings call this week, how does that translate into, okay, what should I be anticipating for my self-storage assets?
Love it. Love it. Love it. And so let's dig into a little bit of self-storage. We're going to start, I want to build on something we talked about last week, and I'm going to share my screen here real quick, and we're going to share a graphic. And thanks to our friends at Tract IQ, Amazing data that they've been willing to share with us. And I wanted to talk through this because I love this chart because it really kind of highlights the last 6, 7 years of what we've seen happening. I'm going to go back to, the first date on the bottom is 1/1/2019. So you see before that is 2018 data, and you can see street rates and web rates kind of paralleling, right? And a pretty clear pattern. The first half of the year rates go up, the second half of the year they come back down. Very similar pattern into 2019, starting that pattern into 2020 when COVID happened. And then the immediate response of the REITs was to drop prices because they thought there was going to be a decrease in demand. What happened, obviously, in hindsight, very easy to understand, is the exact opposite happened. And we saw this incredible run. The REITs gained 66% in value over the course of that timeline until near the end of 2022. I want to jump to 23, Chris, and one of the things that stands out is how there really is no pattern. You see this drop, spike, drop, spike, drop, spike repeatedly through the course of the year. I think one of the things that I'm taking solace in, and one of the reasons I'm so gung-ho about storage as a long-term play, is because as you got into 2024 and now we're into 2025, you're starting to see more of a recognizable pattern of what rates are going to look like over the course of a year in the storage market.
I think what's fascinating, one thing I want to back up to, because you mentioned this prior to the show in that 2022 market, if you can remind us why the precipitous drop in 22, what happened there?
Yeah, I mean, that's April of 2022. Late April was when Jerome Powell and the Fed decided to raise interest rates and indicated very clearly that not only, I think that first jump was 50 points, that they were going to continue, right? They were very clear that this was not going to be the only jump. And you saw it had a tremendous impact on the overall economy relatively quickly. And the REITs kind of changed their tune about how they were advertising rates. And I mean, this is not an insignificant drop. You're, 215, 220 a square foot for your average street rate and drops all the way under a buck 75 in a matter of a few months. It was a very drastic change for the industry.
And I think that what I want to do is speak to the 23, because if I remember correctly, that was about the time of the Life Storage acquisition for Extra Space. And so
100%.
if you think about what you're seeing there with this being all over the place, that was a big part of the ECRI conversation. I think that's a newer strategy, right, for the REITs. So I think that's where they're kind of testing this model, going, hey, is this going to bode well long term from a revenue per square foot? And I think they're kind of testing this out. As you can see now, as we've become more prominent, as I say, on the lips of legislators, you can see that, hey, maybe this ECRI strategy isn't everything we thought it was going to be. So again, you're seeing some changing dynamics, but it appears to be kind of steady growth and rate, which we've seen in the past. And we'll see if that bears out to be true in 25 or not.
I think that we'll obviously keep you guys informed. We expect sometime around the second week of July to have this chart accounting for what's happened in June as well and get a much clearer indication. One of the things that I really think is powerful about this chart is the steepness of the increase that we've seen in early 2025. Already the line is peaked above the peak of 2024. Do we see a little bit more growth before the downturn towards the end of the year, if that downturn actually happens? And something that you always talk about, I guess I want to ask you, what do you see happening with this pattern going forward into late 2025, 2026?
Yeah, I think the good news, everyone I'm talking to, they're seeing occupancies up, they're seeing rents going up. So that's obviously very, very good news. What I'm anticipating is we're going to see that probably through the end of June. Maybe it stopped in May. But as you've seen in this pattern in the past, I think from probably July on, rates will go down. The thing that we want to be looking for, again, if you're a stock guy, you'll understand this as kind of a higher low. So throughout the rest of 25, do we anticipate that this low is going to be above, a buck 50, for example? If that's the case, I think that's going to bode well for what we're going to see going into 2026 and that growth part of the season.
I think that's exactly what I'm looking at as you look back at 2018 and 2019 and never dipped on street rates below a buck 50. We've seen them below 150 in 2025 early in the year. Can we get back to that place where we're gradually having that 3 to 4% year over year growth and not going backwards as we've done for the last couple of years? Going to be something to keep an eye on. And as always, at the Self Storage Report. We'll be sharing that data with you as we get access to it. Again, shout out to Noah Starr and his team at Tract IQ for sharing that information with us. Much appreciated.
So let me jump into some information. I want you to poke holes, ask questions.
You
Let
got
me
me
see if I
smiling over here. I've been looking forward to seeing this because I
I
know
can
how
get this
prepared you are and what you've been
correct.
digging
So
into.
we'll bounce around and have some fun. So here's eventually what I want to get to is typically home builder stocks can be a very good indicator or precursor of what's coming within the economy. So I want to sort of lay some groundwork. And again, as I'm sharing this, continue to think about, okay, so what does this really mean for self-storage? And we'll tie that in here. So just broke today, US Q1 2025 GDP revised down. So I think what's important for people to realize, this is the first time it's been negative since Q1 of 2022, which I think is kind of a surprise for people. But again, you just mentioned in 2022 is when he dropped rates, didn't have a big impact on GDP. I don't know if this is, from tariff conversations, if it's just weakening, right? Because I think, again, the housing market is a good indicator. You can see here from Equity Clock, they're saying this is the second largest May decline in new home sales since 2010. So just keep that 2010 marker because we all know the GFC back then, the collapse that took place. Oops, I'm not sharing this correctly, but keep that in mind because that will be important as I get to that in just a moment. So if we will talk about, hey, is the economy actually beginning to soften? I just want to play some clips. KB Homes had their Q2 2025 earnings call this week. So rather than just trusting what I say, let's hear what some of the leaders at KB Homes are saying. Because when you think about it, the data that these people have are able to see and see the
Yeah.
trends that are happening within different markets, it's incredible. So I think it's really valuable to hear what they have to say. So here's the earnings call on the economy from KB Homes.
As to market conditions, while longer term, the outlook for the housing market remains favorable, driven by demographics and an undersupply of homes, consumers are continuing to demonstrate a lack of confidence about the short term, which has impacted their home purchase decisions. Affordability challenges have persisted, compounded by the variability in mortgage interest rates, which remain elevated, as well as macroeconomic and geopolitical uncertainties. These factors resulted in a more subdued demand during the spring selling season. As a result of this softer environment, we are revising our guidance for fiscal 2025.
So obviously that's not great news, right? From an economic standpoint, we talked about this last week with Lennar dramatically lowering the price of their homes. I think we said by almost 9%. One of the interesting things, because you alluded to it earlier in the call, to think about with Lennar is they're giving out these incentives. If you remember, 13.3% of their margins right now are going towards these incentives to help people get into these homes. One of the things I didn't think about, but heard this early this week is some of these people that are buying these incentives, right, may end up underwater at some point on these homes when it's time for them to sell. So we can get there if you want. But one of the things that jumped out to me, and again, I'm in land acquisition for self-storage. Let's tie this in now into self-storage. And what does this mean for the next 13 to 24 months? And
Bring
so,
us back on camera, Chris. As much as I love KB Homes, I'd rather see you talking at this point.
okay, let me see if I can figure this out. So thank
Yeah,
you
look
for
at
that.
that. That's my Batman right there.
Um, so I just want to share that one of the interesting things about KB Homes is they actually pulled out of 9,700 land deals. That's a lot. So just to let that sit with people.
I would repeat that number, right? 9,700 parcels of land. And just for people who aren't familiar with home builders, they are not typically putting 1 acre of land. Like KB Homes is not going and putting the lot you see driving down a local side street that says buy this lot to build your home. That's not what they're buying. They're buying 100-acre tracts, 1,000-acre tracts, and they dropped 9,700 contracts on tracts of land across the country. It's almost hard for me to wrap my head around what that looks like, Chris.
Well, I'm going to get to a clip in a moment, but I do want to share something here because I think you're making some really valid points, and this may actually set this conversation up better if I do it this way. So, as I said a moment ago, typically you're going to see housing stocks be a leading indicator, right, of what's going on in the economy. So back in July of 2005, KB Homes hits an all-time high.
Yep.
So think about what happened right after July of 2005. You're getting into the GFC, which I'll explain more about that in a minute. So as of today, which I don't think this is going to go back to an all-time anytime soon, as of today, the all-time high was really September 2024, like you and I talked about. Again, when Powell lowered rates on September, I think it was 15th of 2024. But just to strengthen this thesis for people, that was KB Homes. Here's Lennar, and we talked about this before. Lennar, Pulte, KB all had all-time highs in September of 2024. Again, same thing with Lennar. Their all-time high was July 2005. Same thing as KB Homes. You go over here, their all-time high, September 2024. Now, what's fascinating about that, because you talk about an 18.6-year real estate cycle, if you go from July 2005 to September 2024, 19,
Yeah.
19.2, right?
Right there.
I mean,
Yeah.
it's right in that ballpark. Now, why does this matter? Because typically, according to the real estate cycle, you're going to see the housing stocks dip first, then you're going to see land prices start to dip, and then you're going to see the equity market start to dip. So if you extrapolate out from 2005, that sort of makes sense because it was really 2008, when the markets crashed, right? So why does this matter to you and to me being in real estate? Well, I thought this was a really good clip. You had one of the analysts ask them about, hey, what's going on with your land acquisition strategy? Again, I think it's always good to take it from the horse's mouth. So I'm going to share that exchange and what KB Homes had to talk about from their stepping away from, again, 9,700 pieces of land.
For taking my question. I just wanted to follow up a little bit on the land spend. Can you just help us understand how much land inflation is flowing through your P&L today, sort of in the back half of the year, and land that you're contracting today? Are you seeing any relief on land prices? Has that come down at all with the softer market? And is there a point here where we could start to see sort of land prices come down as we go out into 26?
We don't have the exact numbers that you're asking for here with us. But one of the things that we're seeing that you don't hear discussed much is you tie up a piece of land, you get it entitled, you go close, you move on, and the improvement costs went up quite a bit due to the supply chain, or in turn oil prices that drove it up, and a lot of the city's fees went up quite a bit. So it's not necessarily just land inflation. So we may have owned a piece of land for 2 years now. We're developing the next phase, and the costs bump up because of those components. The land seller, normally that's the first step, and then you start to see price. I don't think we've seen a lot of go through the rest of this year.
So there you have it. I think it bodes well to say, look, less demand, what typically happens to pricing, right? It's going to go down. I think you summed it up really, really well, but I kind of love your assessment of what you just heard there, Thad.
Listen, I told you this offline that, you know, that's the biggest buyer of land in the country, right? Like, you're not talking about an ancillary buyer that pulls out of a couple deals. You're talking about a massive driver of land purchasing in the country, dropping 9,700 contracts. I told you earlier, you and I do something similar, right? We go out and find development sites for self-storage, in my case, small bay industrial flex projects. I might in a year put 5 to 10, 4 to 10 acre sites under contract. They have almost 10,000 100+ acre sites that they just dropped out of. So to think that that's not going to have an effect on pricing in the land market is almost, it'd be absurd to think that there's not going to be a capitalist response, a capitalism response, less demand, your price goes down. It's almost unfathomable to think that we're not going to see land owners and sellers start to adjust by bringing price down. I've already seen, I don't know if you've seen this on your side of it, it's getting easier to get sellers to come to be more favorable in terms over the last year and a half. To his point, I haven't seen that drastic drop in pricing, although I'm starting to see a little bit more of it. And back to what we've been talking about with Philip J. Anderson in the real estate cycle, one of the big things that he talks about historically is that there's always a boom in land prices a couple years prior to the end of the cycle. And we saw that in 2021, 2022, where land prices went from we were able to buy a storage site, industrial land, for a dollar and a half, $2 a square foot, to all of a sudden people charging double digits. You know, you were paying 10, I mean, literally a 500% raise in your cost of buying land. So we saw that speculative nature in the land area. The other thing that is always tied in is there becomes access to free money near the end of the cycle. I was on a podcast earlier today with Patrick McAllister from Storage Building Company, and he was talking about the storage boom and what would developers tell him? Well, we're getting free money, right? We had the Fed drop the prime rate to zero. The flow of capital was almost hard to fathom. Now we're coming to this point where, by all indicators, in my mind, it's following right along with what it is the previous indicators have been on this cycle.
Well, and I think you and I didn't get a chance to listen to the entirety of Jerome Powell on the Hill, and yet, if you just look at the news, they are doing things within the banks to start to free up capital. But also, if you saw Pulte yesterday from the FHFA saying, "Hey, now you can use crypto to as an asset to say, hey, this is my net worth towards your mortgage," which again to me just speaks about this idea of, hey, we're going to do whatever we can to try to free up capital to go into to real estate for more speculation. And that's when things begin to go in a different direction. So to kind of put a button on this, unless you want to talk a little bit more about, the
I
economy.
want to bring something up because you brought something up this week that I think is very interesting. And we talked about this offline also. We tend not to do like intelligent modulation in our country, right? We tend to do, we see something, we swing way over to the side to try and fix it. It tends to create way more problems, and then we swing back to the other side. You know, California recently had the mansion tax go into effect. That's, I think, pretty clearly had a chilling effect on real estate sales. You're starting to see kind of this blowback of like, maybe, hey, we're going to start to get a little bit more less intrusive, I guess I would say, in some of the governmental policies that are holding back. Are we coming to this inflection point, I guess I would ask you, where, the truth of what some of these restrictive governmental policies, we talked about this. 2 of the 6 oil refineries in California are going to shut down in the next year because they simply can't afford to keep working given the cost of governmental regulation fees, right? And so are we coming to this point in 2025 where some of these policies that have been, hey, listen, I think they're good natured. I think people have a good idea of why they want to put some of these restrictions. But at the end of the day, it's creating more of a burden on the economy than maybe the economy can handle. Are we going to start to see this inflection point where we start to go back and say, hey, we've got to your point about what the Fed is doing, trying to give people more opportunity to buy homes, are we going to start to see some of these policies get reversed to help light a fire under the economy again?
What's amazing about life is earlier this week, I would have said to you, yeah, I think that's got a pretty good chance of happening. Then I saw what took place in the New York mayoral primary, and I'm like,
Unreal.
maybe not. I don't know. So you would
Yep.
like to think so, especially with what's happening here with the ULA transfer tax you just mentioned, and some of. I mean, Rick Caruso is doing a great job. If you don't get my newsletter, please let me know, and I'd love to send it to you because I sort of surmised his conversation at a Connect CRE event in LA last week. But he said he's going to make an announcement late this summer about whether he's going to run for the mayor of LA or the governor of California. Either way, I think it'd be a great move just from a deregulation. Hey, let's get this state back on track and I would say, make California golden again.
Listen, I so appreciate all the information you bring. I guess circling back to self storage. This is
One,
the self storage report.
one thing
We
I do
talked
want to
about
share as
other
you
things.
say that is this, and
Yep.
I think this is kind of where a nice button to wrap things up with, because I had a conversation with somebody earlier this week. So this is DR Horton. This was back in the beginning of the year. But the big thing you hear from Lennar and DB is like, look, man, people just can't afford houses right now. So what are a lot of these guys doing? They're building smaller homes. Why is that good for storage? Because, hey, that just means that you're going to need more space, somewhere to store their stuff. If they've got less footprint in their home, that means they're probably going to need, excuse me, more storage, which I think bodes well for us in this asset class.
Fascinating tidbit that you share there. And I think, one of the things I've always argued with is people have complained about home ownership taking up a greater percentage of people's income over the last 50 years is that, yeah, the home has taken up more of their income, but it's also been a vastly larger home, right? If you compare the typical home that somebody bought in 2020
Right.
versus 1970, it's not even the same product that you're talking about. Are we starting to go back to this place where, and not only smaller homes, but more family members, more of a larger group of the family living in that home together? Is that part of the explanation why, even though the home market's been a little soft, we're starting to see that uptick again in prices in the self storage world? Because that's the reality of how people are living in 2025.
Again, I think time will tell, but there's definitely a lot more multi-generational habitation happening now than maybe in the past.
Yeah. As someone who has two kids that are out of high school and working in the market that are still living at home, I can attest to that being the reality of what's happening in 2025. By the way, happy that they're living with me and in no rush to get them out. But that's just the reality of the world we're living in. My son's 24 years old, has a great job. Shout out to my guys at Go Store It for employing him. He's doing great with them. But the reality is that for him to get to a place where he can go out and comfortably afford even a starter home, it's very different than it was, 20, 30, 40 years ago when you and I were coming into that part of our lives.
So I think to speak to what you mentioned, hey, what's going to be the catalyst going into 26? I don't know what that's going to be. My guess is it's going to be more CRE and these bank balance sheets. But I will say, again, if you talk about, we just mentioned here with Lennar and some of these people end up buying these buy downs, if you will, but end up underwater, that could be a challenge. You've got FHA loans right now that a lot of people, when you've got the college debt coming back online, you may have had, credit scores that are actually higher than they were when they got approved for the loan. So there's gonna, you never really know, but there's enough rumblings going on underneath the surface, if you will, that again, I would just encourage people, be prepared, pay attention to the middle end of 2026. I think you're going to see land prices start to go down there, and we'll see what that means for bank balance sheets.
That was a perfect teaser, right? You're thinking commercial real estate may be the driver of this next downturn in the cycle. Next week, I'm going to prepare a little bit, and Thursday at 1 o'clock, I'm going to show what the reality is today of the value of a property versus 2022, just based off the increase in the interest rates. Forget about the drop in pricing and storage and what that does, potential drop in NOI, just how interest rates have affected value. And we'll talk about how much equity has evaporated over the last 3 years and how that might be a driver of what we see happen. I know you and I, as I said at the beginning, are very much aligned in our belief that if you are not prepared for a potential downturn and maybe significant downturn, it could get a little ugly over the course of the next couple of years.
Just a quick anecdote. I had lunch with a friend of mine recently, and his buddy had an asset multifamily out in the East Coast. 20 million, 20 million in equity just whoosh, evaporated.
Just from interest rates changing, and I'll get into that and do a little demonstration next week so people can understand, because I think especially if you're involved in self storage, I came into it in 2021 and it was the heyday, and we were underwriting to 4.5 cap exits, and we were underwriting to 18-month lease ups, and we were underwriting to best case scenario things. And I can still remember saying you're going to cash out $4 million on a refi at stabilization in 18 months, and looking back on how misguided that was, and want to make sure that I share with other people to really understand, what the reality typically is and how these swings ultimately affect the whole economy. Because what do people do with that equity? It's not just the $20 million of equity disappearing. It's what would that $20 million of equity gone into, and how would that have further stimulated the economy? That now is not going to happen. And I think we're seeing the ramifications of that. It's one of the reasons that I agree with you so much on your prognosis of what we're about to undertake. Listen, we've covered a lot of ground. It's hard to believe. I just looked at the clock. We've been on for a half hour. It's hard for me to fathom that we've been talking for a half hour. He is Chris Berg As I said, if you're not following the CRE report, make sure you are. You saw his email there. He's always looking for land to develop out in California, looking for self-storage sites. Feel free to give him a shout out. There's the link to subscribe to the CRE report. You can get on his newsletter there as well. I am Thaddeus Campbell. I'm looking for land in the rest of the country. I don't like to step on his toes out in California. 4 to 10 acres. I want to build some small bay flex around the country. Feel free to reach out. So many of you have. I don't know if you had this happen, Chris, but love that people are direct messaging me on LinkedIn and sending me emails. Appreciate that. Also, guys, don't be afraid to reach out to us with ideas, with data points, with things you're seeing in the market. We're going to rely on you and look forward to you helping us to guide this conversation. Chris and I certainly don't want to be the only people contributing to the conversation. We want to be an outlet for information. So feel free to reach out to us and help us make the self-storage report what it is we hope, which is an asset to the self-storage industry.
Nice pun.
I try all the time. Guys, that's it for this week. We will be back again. I will be broadcasting clips through the week. That was a hard one to say, but we'll be back next Thursday live at 1 o'clock, July 3rd, helping to prepare you for what hopefully is an amazing holiday weekend.